Hello everybody. Today we will take a look at Chapter 11, Risk and Return. Note that the subject here is the same as Chapter 10, which is the risk and return trade-off. However, we will learn additional measures for the risk, and also the risk and return trade-off will be discussed more in detail. And this risk and return trade-off relation will be discussed more in detail. So this chapter is about how to calculate expected returns and variances. So we will learn a different approach to compute expected returns and variances. And also we will learn a new concept called diversification, which will lead to a new definition called the systematic risk. And based on that, we will learn a very important thing called the CAPM. So, among the sub-chapters that are introduced in this chapter, we will focus on these 6 sub-chapters, and also I would say the most important of all would be the last one, the security market line. But another name for the security market line would be the capital asset pricing model, and this would be the essence of this chapter. So why don't we start the lecture with a simple warm-up question. So the first question here, Tesla, which has been recently into spotlight for many different reasons, was up by more than 700% in year 2020 alone. So why didn't all investors hold Tesla then? And the second question is dealing with the opposite case. So there is a company called Occidental Petroleum, which went down by more than 50% in 2020 alone. Then why did some investors hold the stock, bearing this much of loss? And why didn't they sell out before the price declined? Or why didn't they even short the stock? And that's probably some of the most important issue related to the stock market and investment, right? And you could probably give me more than 1,000 reasons to this pattern here. But before getting into those predictability issue, let's just focus on these numbers, these concrete return numbers, 700% and negative 50%. These numbers were unknown before the year 2020 started. These are only known to you because we just passed year 2020 and these numbers have been realized. So the numbers you are looking at are realized returns. So if you wanted to make a decision related to your investment choices, which are about the future, just have limited information, the concrete number itself will not be predictable beforehand. Okay, so you will have to just keep that in mind. These are something that you couldn't have predicted before the year 2020 started. So the problems with realized returns is that they are unknown beforehand, so that it is not possible for you to make an accurate forecast about the concrete number itself. So we will have to predict returns ex ante, and to do so we will have to make a guess. And to make your guess more educated, you'll have to just start from this the starting point that the stock return is a random variable. I'm not sure whether you heard of this term random variable, but this tells you that the all stock returns will have this kind of probability distributions. So the probability distribution is like the outcomes you will have when you are rolling a dice or flipping a coin. Okay, it gives you what kind of outcomes you will have and what's the probably attach it to that outcome, that particular outcome. That is what a probability distribution is. So a stock return will have its own probability distribution. And let's make it a little bit strict. So let's just add a very strict assumption that a stock return will follow the normal distribution. The normal distribution we looked at in chapter 10, and it will have its own mean, which is called the expected return, and also it will have its volatility, which is the variance as well. And if you have these two statistics, mean and variance, then we can have a clear idea about the distribution of the stock return. So in other words, it's completely described by the mean and the variance. So the outcome will be fully forecastable. It doesn't mean that you will have like one concrete number, but you will still have an accurate range of the stock return, so that it will make it a little easier for you to forecast the future outcome or future stock return. In Chapter 10, we learn how to compute the expected return and variance based on historical return data, which is called the historical approach, or sometimes called the sample approach. Now in Chapter 11, we will learn a new approach called the scenario approach. This approach is used assuming that we are able to forecast all possible states or all possible scenarios in the future, and the probabilities of those scenarios or states being realized, and also for each case the outcome or the return for the stock. Okay, so if you're assuming that we are just able to forecast for the future this much of information, then we can compute the expected return based off of this information. Then how can we compute the expected return in that case? The expected return will be the probability weighted average of all possible returns. Okay, so the generic formula should look like this. And then under the scenario approach, the variance would be very much like the expected return in that it will be probability weighted average of squared deviations from the mean. So we will first have to compute the deviation from the mean, get the square of that, and we will just get the probability weighted average of them, and that will be measuring the variance. So that is just a statistical definition of expected return and variance. How to execute on that computation we will see in a minute. And of course, standard deviation would still be the square root of the variance. So let's just compute the expected return and variance for these two stocks. Let's first start with stock A. So let's suppose in the future there are 3 states being forecasted. So we're predicting that for 25% of the chances, the economy will be in boom. 50% of the chances, neutral. And the other 25% of chances, it will be a recession. So we know that it will be one of the 3 states. And the probability of these, each state being realized is just introduced here. And in those states, if the economy was boom, then stock A would have a return of negative 20%. If the economy was neutral, then the stock's return will be 15%. And if the economy was in recession, then stock A would realize 35% of return. So we don't know which state it would be. However, if it was one of the 3, then we will have negative 20%, 15%, or 35%. This much of information was provided to us. Then, based off of this information, what will be like the expected return? Or what will be the variance of stock A then? Okay, so let's compute the expected return first. So as we saw before, this is the probability weighted average. What that means is you just multiply each state's return by the probability, and then you add them all. So it will be like 25% times negative 20%, 50% times 15%, 25% times 35%. You add them all. That would give you the expected return. So if you did the calculation, it will be 11.25%. So you're expecting, even though it has been realized, right? So you're still looking ahead. So looking ahead, you are, the return amount that you have in mind will be 11.25%. And the variance would be the squared deviation from the means probability weighted average, right? So what you will have to do is, for each state, you will have to get the deviation from the mean. So recall from the earlier example that your mean for stock A was 11.25%, right? So what you will do is you will just subtract the 11.25 from each state. Deviation from from the mean is computed for each state. And then you will have to square all these deviations from the mean. And then you multiply that by the probability at them all. That will give you the probability weighted average of these stuffs, okay, which is the square deviation from the mean. So you can compute that, and then the variance will be 0.0392. Remember that this is not in percentage terms because this is percentage squared. So if we wanted to just provide, like the unit, it will be percentage squared, but nobody just presented this way. So it cannot be in any kind of like percentage or percentage, but you will still have to just provide everything in decimal points. And finally, if you wanted to get the standard deviation, you take the square root of the earlier number and it will be 0.998 or 19.8%. Because you took the squared root of your variance, you can now use the percentage terms. And what if you wanted to do it for stock B? Same logic, same formula applies. So for each state's return, you just multiply that by 25%, 55%, 25%. Okay, so you multiply that by each state's return. Add them all together in the end, right? And that will be like this. 0.25 times 30%, 0.5 times 15%, 0.25 times negative 10%. And your expected return for stock B would be 12.5%. Same thing for variance. So first, you will have to get the deviation from mean. So the earlier number was 12, the mean, or the expected return for B was 12.5%. So you just have to subtract that from each state's return so that you get this deviation from mean. And then you get, you square these deviations. Multiply that by the probabilities and add them all together in the end. That will give you the variance, how volatile your returns would be. And you will get 0.0206. Finally, for your standard deviation, it would be the square root of your variance before. So it was 0.0206 being square rooted, and you will have 0.144 or 14.4%, which should be your standard deviation. You just computed the expected return and variance for both stock A and B. So the formula may look a little bit complicated, but needs a little bit of practice, and you can do that on your own as well. Now, so up to here, we just learned how to compute the expected return and variance based on the historical approach, which we did in chapter 10, and also this the scenario approach we just learned, right? And that was for individual assets like stock A, stock B, stock C, just like that. But a lot of cases, for a lot of investors, it's a norm to hold what's called the portfolio, which is a collection of assets. In other words, people tend to hold more than one stocks rather than just holding one standalone asset. And if that were the case, then it's like just putting like a proportion of your money into one stock, some proportion of your money into the other. But in the end, the sum of all the percentages will have to add up to 100%, right? That is just very self-evident. And even if you hold a portfolio, the risk-return trade-off that was applicable to just one individual stock, it will still hold for a portfolio. And if that were the case, it can be just measured by its own expected return and its own standard deviation. So you would have to, what that means is you'll have to do another calculation. You will have to learn how to compute the portfolio's expected return and portfolio standard deviation so that we would know the risk-return trade-off for a portfolio as well. So the general relation that we learned in chapter 10 was that if you were just trying to, so the last graph of chapter 10 was if we just have risk on our x-axis and y-axis if it were return. Generally, it will have a tendency of going like a positive relation between the two. Now we would like to see, even for a portfolio, this type of relation will hold. So how do we compute the portfolio's expected return then? So to be able to compute that, it's just a very simple logic. The expected return of a portfolio would be the weighted average of the expected return for each asset. So you multiply the asset's expected return by the proportion or weight, and then you add them all together in the end, and that will be equal to the portfolio's expected return. It sounds a little bit complicated, but it will make sense if you just take a look at this example. So let's suppose you have 5 assets in your portfolio. Just hold on to these 5 assets. And the amount of dollars invested would be like 15,000, 8,600, 11, 9,800, 5,800. Okay, so a total of $50,200 were invested into your portfolio. Then the first thing to do if you wanted to compute the expected return for the portfolio is you have to compute the weight. Okay, so this is the weight calculation or the proportion calculation. So for each stock, to compute the weight, what you'll have to do is you get the proportion of asset out of the total dollar amount invested. So 15,000 divided by 50,200, that will be around 30%. So this is, once again, 15,000 divided by 50.2 thousand. Same thing for this weight here, asset B's weight. That was $8.6 thousand divided by 50.2 thousand. Okay, and then you will have about 17%. You just go about the same way. Just want to have the proportion of each asset. That will be the same thing as the weight. Okay, so you obtain these weights and multiply each asset's weight by that stock's expected return. So you probably have to have this expected return beforehand for each stock, and then multiply that by each weight to compute the expected return for the entire portfolio. So 30% or 0.3 times 12.5%, 17% times 9.5%, 22 times 10%, 20% times 7.5%, just like that, okay? Add them all together, and then that will give you 10%, okay? So the amount that you will have for this area here would be 10%. Now, then how do we measure the portfolio risk, such as the variance and standard deviation? So do we measure the portfolio risk in the same manner as we did with the portfolio expected return? So in other words, is the portfolio risk, or more precisely, is the portfolio standard deviation a weighted average of the member stocks' standard deviations? Well, the answer is no. You cannot measure the portfolio standard deviation by getting the weighted average of the standard deviations of the component securities. The reason is because of an additional statistic called the covariance or correlation coefficient. They are related terms, so you can use one or the other. So what it's trying to measure is the co-movement in the member stocks returns. So if you are holding if you're holding multiple stocks together, one stock's return may have some kind of relationship with the other members, and those links, those interlinked relationships, will have an impact on the portfolio as a whole. So let's take a look at this. So let's suppose you have 3 stocks: stock A, stock B, and stock C. In stock A and B, if stock A's returns are going up, let's say stock B's returns are going up, in the same direction, then there exists a positive relation between the two stocks' returns, right? And let's suppose for stock A and C, on the other hand, an opposite relation holds. So stock A's return is going up. In that case, stock C's return is going down, okay? And if that were the case, there exists a negative relation. And to just denote these positive or negative relationships, then we can use this new statistic called covariance. And covariance will be denoted with sigma, with the subscripts of the two stocks that are having a relation, like such as A and B or A and C. Okay, so covariance of A and B, let's say it was positive. Covariance of A and C, let's say it was negative. then let's see what kind of impact it would have on the portfolio. And let's just split the portfolio into two parts just to make it a little bit simpler. And let's take a look at the dynamic return movements across time, right? So let's just take a look at stock A and stock B only. So as you can see, stock A and B, they're kind of moving in the same direction, right? So when A is going up, B is going up as well. When A is going down, B is going down. The degree of the movement, the slopes are a little bit different. However, on a trend, they are moving in the same direction. Now, let's suppose you create a portfolio between the two. Then their portfolio, A and B's portfolio, if you track the portfolio's movement, it will be like a weighted average. Let's suppose it was like 50-50. Then your portfolio A and B, okay, it's on average, its return movement will be like this. So it's probably just, in between the two, but in a nutshell, it's just going the same direction, and the volatility is probably just a bit similar to each other, right? So for stocks that have a positive covariance, the volatility will be probably a little bit similar to the weighted average. But what's more important is when the two stocks have a negative correlation coefficient or covariance. So let's suppose you create a portfolio between stock A and stock C, which have a negative correlation coefficient. And then if you track the portfolio's return over time, then it will be just between the two. The return, remember the portfolio's expected return will be always the weighted average. So the average would be like in between. And maybe if you just get the average between the two, it will be like, maybe it's just going like this. A lot flatter than the volatility of returns you saw for both stock A and stock C, okay? So if you just create a portfolio between the stocks that have a negative correlation, then its volatility over time will be much flatter. In a nutshell, it would look like this, completely different from either of the two, right? So covariance does play a role here when it comes to variance or standard deviation or the volatility itself. So you will have to take that into account to be able to capture and measure the portfolio risk. Keeping that in mind, now let's suppose that you were not given the information about the correlation coefficient or covariance, or maybe you don't know how to compute the covariance. Even in that case, if you know the scenario analysis, or if you know the scenario approach and you were given the states and probabilities, then you can still compute the portfolio expected return, variance, and also the standard deviation. And how do we do that? First, you would have to compute the portfolio return for each state. So for each state, each different state, you will have to compute the portfolio's return for return. And then secondly, you will have to get the overall expected portfolio return using the same formula as with an individual asset. And finally, you would get the portfolio variance and standard deviation as if you were doing with an individual asset. So what does it mean? Let's just do that by applying this approach to our old exercise. So let's suppose you're trying to construct a portfolio by investing 50% in stock A and 50% in stock B. So these are the stock returns that you saw before. And now you're trying to create another portfolio by investing 50-50 into stock A and B. First thing that you'll have to do, which was discussed before, is to get the portfolio return for each different state. So for boom, neutral, and recession, you will have to measure how much the return outcome would be in those states. So how do we do that? We just apply the weighted average of return. So weighted average, so 50% will be invested in stock A, 50% would be invested in stock B. So in case of boom, half of your stock will give you negative 20%, half of your stock will give you 30%. So on average, you will be expecting 5% of return in case of boom. Same thing for neutral. Half of your portfolio will give you 15%, half of your portfolio will give you 15%. The same, so 15%. for neutral. What about in case of recession? Half of your portfolio, stock A, will give you 35%. Half of your portfolio will give you negative 10%. So on average, you're expecting 12.5% return for the recession. And so that's how to complete step 1. Step 2, treat each return as if it were an individual asset and apply the same formula as you did with your old exercise, which is just getting the probability weighted average of each return. So 25% times 5%, 50% times 15%, another 25% times 12.5%, and you will have 11.88% for your portfolio expected return. Now, what if you were trying to get the variance in standard deviation? You would probably have to just do the same thing, just treating portfolios return for each state as if it were an individual asset. All right, so let's first get the deviation from mean. So you will have to get the deviation from mean by just subtracting the 11.88%, okay, which was the expected return from our earlier slide. Get the deviation, square them, and you multiply that by the probabilities. And so you will have the variance for the portfolio, which will be 0.0017. Now get the standard deviation by square rooting it, and your standard deviation will be 4.10%. So that was the mechanical part of getting the portfolio's expected return, variance, and standard deviation.